Hello everyone, welcome to Simplii Finance. I am Parthasarathy, founder and mentor at Simplii Finance. In this series of tutorials, we will be covering CFA Level 1 complicated financial concepts, and these tutorials are structured in a way to include real life applications and to simplify these concepts. In this series of videos, I will be explaining totally 50 concepts in a short video format, and I will be uploading them one at a time, so do stay tuned. These videos will be helpful for students and working professionals who want to enter into the finance industry, and the video format is a short format to have a conceptual understanding. To stay updated with all these new videos, do not forget to subscribe and hit the bell icon. And now let's get into this video. So the first LOS is on revenue recognition principles, and this is based on IFRS. We have totally 5 steps in revenue recognition, and let's look at that for an example. So here we have a lovely student who wants to join our academy for CFA coaching, and we are expecting from him 30,000 rupees for the entire CFA level 1 coaching. So the first step is to identify the customer. In this case it is our student. The second step is to identify the performance obligation. So let's split up the CFA level 1 curriculum into 6 modules, for example. So as and when we finish each module from our coaching center, we will start recognizing that as revenue. So in this case, 30,000 for the entire fees, that is going to be split up into 6 modules. So as and when each module gets completed, we start recognizing 5,000. In such a way, at the end of the 6th module, we would have recognized the entire 30,000. So this was the revenue recognition according to the IFRS. Now the LOS also open up to multiple revenues. First is on long-term contracts. So let's say you are a contractor with a long-term 10-year contract for $10 million, and how do you recognize that into the income statement? So that is going to get recorded based on the percentage of completion method. So what does that mean? So as and when you finish your performance obligations for each stages, that is when it's going to get recognized as revenue. So for example, if the total cost that you're expecting out of this project is 8 million, so in the first year, if the cost incurred is 4 million, that becomes 50% of the project completed. So you recognize out of the entire 10 million, you recognize 50% of that, that is 5 million as revenue. In the next year, you had also incurred a 2 million cost, additional cost on the total 8 million. So up to the last year, you have incurred 4 million. In this year, you have incurred another 2 million. So totally 6 million out of 8 million is already incurred. So 75% of the project is completed. Now this is a cumulative value, which means 50% of completion was in the previous year and 25% is in the current year. So what we need to do, we need to just recognize the balance 25% in the second year, because 50% is already been recorded in the first year. So next kind of business is acting as an agent. So let's say you are a travel agent, so your revenue comes from commissions. So as and when you earn the commissions, that is when you will record it as revenue. Next, franchisee and licensing. Franchisee and licensing, let's say you are a fast food hotel restaurant chains, so you get revenue based on 3 different sources. First is from your own restaurants that you own and operate. Second is from royalty and fees, and third is from selling goods to your franchisees. So this is how you are supposed to split the revenue and show it in the income statement. Next, services versus licenses. So what happens here, there are 2 ways for you to report this revenue. First, as and when you get cash, you record the cash in your asset side of the balance sheet, and also you record something called unearned revenue. Unearned revenue also goes up. This becomes a part of the liabilities. So here, as and when the performance obligation is done, the unearned revenue comes down and the income statement revenue goes up. So the two ways for you to record is, first, as and when you record cash, you will increase your cash and unearned revenue. Then as and when you complete your performance obligation, the unearned revenue reduces and the income goes up. Or if you want to recognize the entire thing as revenue, you increase your revenue and simply show everything as cash. Okay. Next is on the bill and hold agreements. That is those inventories which are not left your godown, but you have billed them to your customer. So the customer pays you on beforehand, so your cash increases and unearned revenue increases. Once the inventory is shipped out of your godown, then the unearned revenue reduces, and this is offset by an increase in income, that is revenue. This was your first LOS. The next LOS is on expense recognition. So expense recognition is basically from this principle in your accounts, that's called the matching principle. Now what does the matching principle tell you? As and when you recognize your income, it has to be matched by the expense. So what does that mean? So here, let's say we are a coaching institute, which we collect a total coaching fees of 900,000, and let's say the teaching fees was teaching expenses for the teachers was 300,000. So totally we have a gross profit of 600,000. But let's say the coaching is to be catered for 3 months. So each month you recognize 300,000. So even the teaching expense has to be recognized in the same manner, that is divide by 3. So as and when the income gets recognized in the income statement, it has to be matched by a expense. So that is what is the matching principle. Now let's say you are a trading company. Okay, you are a trading company and you trade goods, and this is your godown. This is your godown. Okay, you had a sales of 100 units. Okay, you had a sales of 100 units and you had this sold for an average price of 15 rupees. So the in your revenue total is 1500. Now in your godown, there is an opening inventory of 50. You had some purchases of 100 and you had a closing stock of 50. Okay, which means in your godown during the year you had 150 goods available for sale, out of which you had sold 100 goods. You had sold 100 goods, in such a way left with 50 goods. Now for you to recognize your gross profit, the COGS, that is the cost of goods sold, the cost of these actually goods sold should be matched with the units of sale. Okay, so 100 units only this should be matched by. This is what we are trying to say on the matching principle. For you to recognize the gross profit, has to be whatever the sales quantity has to match with the COGS quantity, so that you are able to get a perfect number for the gross profit. So here let's say the COGS, the cost of these goods which were sold was 10 rupees. So this had a cost of 1000, but you sold it for 1500. This leaves you with the gross profit of 500. So the matching principle is what is used for you to understand the gross profit perfectly, because the sales quantity and the COGS quantity should always match. Okay, so another simplified formula for COGS, that is the cost of the goods sold, is opening stock add purchases less closing stock. These both is what will make up for the goods which were available for sale less closing stock what was left over in the godown. So this totally will make up for the sales quantity. Capitalizing versus expensing. So this is seen a lot in the actual markets. So there are few companies which capitalize their assets and few companies which expense them. So what's the impact in their income statements or the balance sheet is what we're trying to see here. So here we have one company, again an educational institution. So they have bought tables, and the tables have bought for being 10,000. So there's another education company. So we are trying to compare two education companies with the same financials. So the first company, they show the tables in their balance sheet has office equipments. So their assets increase, that is the tables goes into the office equipments and the cash reduces. But the other company, another education institutes, they expense it out. They do not show it into their balance sheet. Now this is what we are trying to find the difference, how these both will be treated into their income statements. So here I have taken the income statements or the balance sheets of these two companies. Let's call them one capital company and other is the expensing company. They both have the exact revenues. Both of them have revenues of 2,000 rupees for each year and a cash expense of 500 rupees. First difference is that the capitalizing company shows the asset into the balance sheet, as you can see here, and claims for depreciation and charges depreciation. So the income statement will show depreciation for each of the year for the capitalizing company, assuming that the tables are for 900 rupees and it's been depreciated for 3 years. The depreciation will be 300 per year for the next 3 years. So this, what it happens, the income statement has a smoothing effect. Every year the income statement shows the same net profit for the next 3 years. But if I am expensing the entire tables, what happens? The first year has the entire 900 rupees expensed off. So the net income is shrunk significantly in the first year compared to the two companies. But if you see the jump on the year on year, the net profit is significantly jumped here. You can see it's almost 2.5 times. The reason is there is no other depreciation to show here, and that's why it's jumped up by 2.5 times. Okay. So the first observation, the capitalizing company shows higher profits than the expensing company in the first year. Moving on, the next couple of years, the expensing company shows higher profits because there is no depreciation charged here. Okay. Next, the income variability. The income variability means the year on year income profit movement is higher for expensing company, meaning that it is highly volatile. So if you can see the jump, it's almost 2.5 times, but in the capitalizing company it's almost flat. So there is lower income variability. This is what you want as an investor. Next, moving on to the cash flow statements. The cash flow from operations here is quite constant for the capitalizing company because there is no change in the net income. But in the expensing company, the cash flows from operations have jumped a lot because of the variability in the net income. Okay. So here the cash flows from the capitalizing company for the first year is going to be always higher than the expensing company. Why? Because it's all expensed out in the net income itself. Okay, that's the reason the cash flow from operations in the expensing company is going to be lower. And the cash flow from investing is being shown for 900 rupees. That's the fixed asset cost for the capitalizing company. But there is no cash flow from investing. Why? Because everything is expensed out. Okay. Moving on to the balance sheet, you start in the capitalizing company, you start showing for the fixed asset net of depreciation, but here there is no fixed asset shown. And here if you can see, the net income increases every year by a constant amount, and therefore you don't see much variability or the ups and downs compared to the expensing company. So the expensing company has a significant amount of variability. So moving on to the ratios, the net profit ratio is almost constant for the capitalizing company, but here if you can see, it keeps moving up and down for the first couple of years. Even though it seems favorable in the shorter term, but this variability is not sustainable. The sustainability is not there. Alright, next, the return on equity. Here you see the first year is shrunk a lot because it's all expense. The machinery is expense, that's why the ROE is shrunk. And here there's a significant jump upwards because there is no more expense to show. But here you don't find significant movements in the ROE. And in the first year, if you see, the capitalizing company is going to have a higher ROE compared to the expensing company. Again, the reason being it's been expensed out. But in the next couple of years, the expensing company is going to have higher ROE. That's because it has no expenses to show. So this becomes quite important for as an investor and also for a CFA candidate for their examination. So that's all from this LOS. Thank you. Okay guys, I hope that today's video was clear and easy to understand. If you have any doubts or questions, kindly DM us in our Instagram ID, which is given below, or in the comment section. Don't forget to subscribe and turn on the bell icon so that you'll be notified whenever we release a new video. Thank you so much for your time and looking forward to seeing the next video.